Florida homeowners and buyers just got hit with several major developments that could reshape the housing market over the next 12 months. Two new important Florida bills have just been signed into law. Builders are facing their biggest slowdown since the 2008 housing crash. Buyer demand continues to weaken, and for the first time in years, renting might actually make more financial sense than buying in many situations. In today's report, I'll explain what all of this means for homeowners, sellers, buyers, and investors, show you a resale bidding strategy that recently helped one of my buyers win in today's market, and explain why I believe this summer could become one of the biggest turning points Southwest Florida has seen in years. And make sure you stay till the end, because I'm going to show you why one of the biggest pieces of real estate advice you've probably always heard, it's always better to buy than rent, isn't necessarily true in today's market. Welcome to this month's Southwest Florida Housing Intelligence Report. I'm Ed Zoller with Villa Realty Group. I've been a full-time realtor here in Lee County for more than 25 years, helping buyers and sellers navigate through every type of market, from the housing booms to the crashes and everything in between. Every month, I bring you the latest graph, the latest data, and most importantly, I do the math so you don't have to. My goal is simple: to help you make informed real estate decisions based on facts and not headlines. If you're buying, selling, investing, or simply wondering where this market is headed next, you're in the right place. Don't forget to like, subscribe, and hit the bell notification icon so that you get these updates once per month, along with my short videos designed to help homeowners. Let's get started. So I gave you last month the bill that was being proposed. Well, they were in session, and the Senate then did squash a couple things, so a couple corrections with this. One, they did not go to the $250,000 in year one. They broke it down into $150,000 on year one and going to $250,000 on year two. And they were including the school portion tax of that in the original $250,000, and they have taken that out. So schools are not affected at all. Schools will continue to get all that increased revenue from all the increases that the taxes have occurred in the last 3-4 years. And so your tax bill won't drop down to zero, because half your tax bill is still schools. They also did away with the whole creating a state trust funds to help the fiscally constrained counties like Dixie, Baker, Calhoun, Glades, Highland, Hendry. Don't worry about Lee County, Orlando, or Miami. They make plenty of money. But they did take that part out of it as well for now. And then the last thing that was it. So whatever you're going to hear out there, core services, firefighters, schools, law enforcement, parks, nothing changes with that. What it's designed to do is to help homeowners, primary end users, Floridians. It's going to save them on that, and it takes effect January 1st if this vote goes through. So a couple changes, not too major, but for now, this is what's on the docket for us to vote on. And a couple things that changed. We had two laws that just got signed into Florida law. House Bill 1329. And I think these are good bills. But these are law. They're not on a docket. They're not being voted on. They've already been signed into it. House Bill 1329 makes more transparency. If your taxes go up, the public should know why. First, they're going to make counties' budgets be presented in a simple, easy-to-read format, not buried in a 400-page document. They're going to have more public workshops and hearings before they ever try to increase taxes. Counties, if they're talking about increasing millage rate or taxes, they must identify at least 10% in possible spending reductions before they could ever propose a higher millage rate. Didn't have that before. It's going to be much more greater transparency. So that is a good thing. I think transparency is a good thing. I think we should understand before they just say we're going to increase our taxes, then we should know about why. And then Senate Bill 4F got passed as well. If a county wants to increase its millage rate, anything up to 10%, it now requires a 4 out of 5 supermajority vote, and it has to be in a public hearing, not in a meeting, as opposed to maybe behind closed doors, or before it was just a 3 out of 5 vote. And if they want to increase your millage rate, your taxes, more than 10%, it will require a 5 out of 5 unanimous vote. So those are good bills to just keep these counties in check. So if you want to know more, I have the SaveOurHomesFL.com you can go to. And just remember, in November, we are going to be voting on HJR 1F. That's going to take homeowners here and give them some reprieve. I would expect your tax bill to go down a little over $1,000. I know last month I talked about my own personal tax bill would have gone down to $800, saving me like $4,000. But even if it's something is better than nothing. And it is going to help. 60% of homeowners have an assessed value under $250,000. Are they still paying taxes? Yes, because the school's portion is still in it. But that's a good thing. Anyway, let's get to the inventory. Inventory, as you know, in Lee County, it goes up, it goes down. And as you can see here on these graphs, going all the way back to 2016, it hits a low in September. And then the inventory builds. We call this prepping for season. The inventory goes up, it goes down. It peaks out in March, which is the start of our season. And then we have what's called the dead zone as the inventory drops all the way back down to September. You can see it did it in 16, 17, 18, 19. We skipped this slop that we call COVID, where inventory just went down, 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 down forever and never went back up. And you can see it is formulating those peaks and valleys again. It did it in 24. It definitely showed a big one in 25 where it peaked in March. And as you can see here, our inventory went down 5.6%, call it 6%. That's positive. If the inventory is going down, that means less to choose from. It's still 30% higher than our long-term average. So we still have a lot of inventory. It's not an inventory shortage because there's still 9,800 things that you can buy in Lake County right now. But one thing I did notice of this 9,866, the new construction is at 1,748, which is a drop of 260 homes. And I just had to look into that. I had to make questions about why. Did they sell that many homes? The answer is no. 260 of these homes expired, terminated, or withdrawn from the market. We'll explain that a little bit later, why maybe a builder would do that, or a bunch of builders would do that. But even though you see that number go way down, believe me, the builders have plenty of inventory, and that's what my next chart is here. The statement I made in the beginning. This is a graph going all the way back to 1998, and I can thank the Census Bureau for this one. And what it does is it shows of builders, national builders who have land, what they're doing with that land, how many months of inventory they have on their completed spec homes, they're under construction, and their house is not started yet, which means they own the dirt, they pulled the permit, but the permit hasn't even begun through its process. Maybe they just applied for the permit. And look at how much months of inventory they have. 21 months of this to be built, but not under construction yet, homes out there. Now, this is in the country. So a couple things that I saw different is if you do go back to the 08-09 turn where they had 18 months of inventory under construction, you know, we are right around that 14, which puts us back to that 2009 range. But the completed spec homes, and here's the good news on it, it does look like the move-in homes are still selling well because these builders are giving out these great incentives and these rate buy downs so they can sell. They only have 3.9 months of completed inventory, but what about the 15 to 16 months of inventory that we haven't seen yet or that are under construction yet? So what this is telling me, and definitely is, this makes for buyers out there, this should make you smile because this has got to be one of the best negotiating opportunities that we've seen in years for you buyers going after these builders. The graph tells us the builders are really hitting the brakes. In my opinion, builders are going to keep pulling back on future construction while fighting hard to sell the homes they've already completed. I don't believe 2026 is another 2008, but when I compare the warning signs, history does repeat itself, but I call it rhyming. It's definitely starting to rhyme. And that's why I believe this summer will be a much tougher summer for builders and sellers out there, and much better for you patient buyers out there. And demand, let's talk about that. And as you can tell, just like the other ones, it always tends to bottom in the same month every single year, starting back to COVID, and it peaks in the same month. It peaks out in March, where we have the most buyers that we'll ever have for the entire year. 2021, 2022, 2023, 4, 5, and then including this 6 here. It's going to be the highest that we've seen all year. And what does it do? It takes a drop all the way back down to where we have the lowest buyer demand in January. Now, 2025, it showed a little bit higher. So I tried to draw these channels to say, hey, we want to see a break of this downward trend. But even though the sales 2026 January were higher than that of 25, I just have to remind you guys, but January 2025 was the worst sales in Lee County's history in over 40 years. Compared to last June, we are up 11%. So at least we're not 2025. 2026 had a little bit more, but 1,296 sales when we average 1,700 sales a month is not that great, although we are in our downward, done with season, and wait till our September when we start prepping for season again. It is a 5-month negative trend, and we are expecting this trend to last 9 total months. So we should have another 4 months of this. So now that you understand buyer demand, where are these buyers going? Are the buyers coming? Well, let's talk about that. There is one thing that does determine what a house price is worth. Obviously, we talk about affordability, stability, and things like that. A new stat just came out from apartmentlist.com. Now, these are apartments. These aren't rental houses. Fort Myers Cape Coral just ranked number 2, biggest cut in rent since 2022 in the country. Negative 19.4%. That's how much rent has gone down. I went further with them, and they had a graph about Cape Coral, where the average rent on an apartment went from $16.95 down to $12.71. That's a 25% cut in rent. Buyers that we're waiting for, sure, we got a lot of people that come down from the snow states, and they come down from Canada, or they come over from Germany and all that stuff. But the majority of our buyers that we have, especially for the entry-level market and the mid-tier market, they are renters turning into home buyers. And so I did a little bit of math, as I always promised I would. If someone can rent a place for $1,271, why would they go buy the median home, which right now is at $380,000, take the average mortgage rate right now, which at 6.6%, go through the down payment, get a monthly payment of $2,403 plus the taxes, plus the insurance, and I even threw in $300 of maintenance costs. About 1% a year should go towards that, and pay $3,355 when they can rent a house for $1,750. Think about the savings that you would get. And so these renters turning into home buyers, we may not see that this summer because, especially Cape Coral, Fort Myers, we have seen such a huge reduction in rent. So this is, I'm not saying don't buy because someone on YouTube told you to, and don't rent because someone on YouTube told you to. Run the numbers first. But I like to run numbers in a situation. I have an entire calculator that will come up with all of these things. And something that's fun, if you rented for 5 years and didn't buy that home and pay that mortgage for 5 years, and you invested the difference, and let's say you can make 6% out there in the real estate market, then in this case scenario, especially for Cape Coral, Fort Myers, renting outweighs buying, by the tune of you'll be $76,000 more wealthy renting than buying for your typical house, your average house out there. If you invested that and make 6%, well, there you go. You almost have 6 figures in a 5-year span. And then you can go buy the homes. This is why I'm talking about affordability, is when renters now have a choice, because a couple of years ago, even last year, there wasn't much of a choice. Rent was extremely high. Look how high just an apartment was, $1,700. And our mortgages were around $2,000. It was much closer. But now, because rent has dropped so much, this could imply that buyers will not be coming and flooding back into it if from the renter to buy a home scenario. So I thought those were interesting stats to go over. The affordability graph, this just takes the average home in the average location, the average size, which is about a 1,700 square foot, 3-bedroom, 2-bath home, and it calculates what the average household income is. And I do all this math and I put this on their color and on this color-coded graph. And you can tell since 2006 or 2004 and 5 that the affordability part has always been in the green zone. Briefly in 2018, it kind of popped above that affordable zone. And that's because the Feds increased the interest rate temporarily, and then they dropped it. And you can see how the graph plummeted right back down and things got really affordable. I kind of drew a graph and saying, yeah, 26% is our long-term average. But in reality, affordability is always around 20 to 24% of your gross income. A quarter of your gross income going towards a mortgage or rent is affordable. But anytime we've ever popped above that 26%, it hasn't been for long. It rises up all the way as much as 54, 55%. That's not affordable. And what happens? It adjusts and comes back down. This graph is hovering right around 31% for Lee County right now, which tells me that people can't afford $2,250 a month, not based on what they make here. They can afford about $1,750. That's where we need the mortgage payments to go. And it's not just price that does that. It's interest rate, taxes, insurance. There's 4 angles to a mortgage when people mortgage a home out there. So it doesn't all fall on burden of price to come down, but our interest rates looking like they're coming down, not according to the Fed chair just came out and said we actually might have an interest rate hike. Our taxes going down, well, if they pass that bill, then maybe for next year, but that won't come to fruition until November of that year. And then insurance, unfortunately, is not going down as I thought it might. I thought after the hurricane, we'd already see this back when Charlie happened in 2005. Insurance got real expensive for a couple years, and then we got it back to affordable again. It's been longer than a couple years since Ian and Irma, and it has not really adjusted. I'm still seeing high priced insurance out there. So if that tells me the only thing that can move right now is price. The median home price, though, is it going down? No, it is kind of flat. And if you look back from 2000 all the way into this boom, you can see where this graph, this orange graph here that I did, represents what people can afford based on household income. And you can see here, real estate over time just likes to chug along, going up its 2-3% a year. But there are moments in history where it far exceeds that 2-3%. And what happened? Well, in 2006-07, we can see exactly what happened. It dropped below that graph, hovered, and then stabilized right around 2014, and then it just followed its course and was a normal, predictable market. And then as soon as COVID happened, what happened? Way up there again, where the median house went up to $400,000 when it was literally at $210,000 just before the start of COVID. And now we're still hovering in that $381. But that is the median home sale price. Of these homes that sold, 87 of those were over $1 million. Now, that is a 32% drop from last month. I've been telling people the $1 million market's doing fantastic, but a third drop, 32% drop from last month says that, well, it is our non-season, and this is what happens. We get hot. People don't want to come down and look at $1 million homes, I guess. There was a $9.5 million home that sold on Bonita Beach with over 5,200 square foot and sitting on the Gulf of Mexico. So really, the high-end market doesn't care as much about interest rates as the median and low-end market, but still, 393 home sales were new construction, which is about a third of all of our sales, but that is a drop of 8%. And this is when I saw that, and then I saw that the new constructions lost 300 homes. I'm like, something had to happen. And did I catch them? I think I caught them. What I would expect with this graph is that big stubborn mule is it's probably going to start coming back down again, cross this line, maybe go back into just like it rinse and repeat. Remember, history repeats itself. I always say it rhymes. It doesn't repeat itself exactly, but it does rhyme with what happened before. Stabilization graph, this takes the Zillow home value index going all the way back to 2000. And what it shows you is how much a home is appreciated month by month by month by month. And as you can tell, back in 2000, it was going up 0.7, 0.6, 0.5% a month. And then during our boom, it was going up 3 to 4% a month, or 36, 40% a year. What did it do? It immediately started crashing back down, and for 59 consecutive months, once it crossed that threshold in 2007, houses were losing as much as 3% a month on the bottom end of it. It took 59 consecutive months to what I call stable, where the house wasn't losing, it wasn't gaining, it was just maintaining itself. And immediately it popped up to appreciating back to that 0.3, 0.7, 0.8% per month again. But then look what happened after COVID. Right back up to 3 to 4% per month. And it lasted twice as long as the last one, where we were appreciating way too fast during the years of 21, 22, and 23. And as you can see right now, currently, we are heading back down again. We are at negative 0.35%. That is lower than what we were at before. It did look like this line was going to play catch up and get back to zero, but I told you guys a few months ago as it was going up, I wonder if it's going to see resistance at zero or if it's going to show support, and maybe we are stable. And as you can see here, it rejected it. We are at 34 consecutive months of negative home value growth. The last time we crashed, it took 59 consecutive months to rebound. And if I did crap this out, it did take 7 exact years from peak to stable. And if I do that graph from here, then that is 2029. Sound about right? And that's be about 59 to 60 consecutive months. So maybe this is the crystal ball we were all waiting for about, hey, when's the market going to stabilize at? Maybe in a couple of years. Comparing month-to-month stats, we have June 1st. We did lose that inventory, 6%. We did have our sales go down 6%. The pending sales tells you the future sales. And if we are down 6% in pending sales, 1,226, we can't sell 1,226 if only 1,226 went under contract, because a third of those are falling apart. New construction had that huge 13% drop, but I think I found them. They're all sitting in expires. The average time on market of 95 days stayed the same, but I just want to reference this for you guys who haven't watched my videos. 95 days is an extremely long period of time when we were at 48 days prior to COVID, and then during COVID, it was a week, an hour, a minute. I mean, we had no days on market. Houses hit, they left, they disappeared, they closed within 30 days. We're at 95 days. The average time on market, and that is really, really bad. It's one of the worst that's out there. Median asking price went up 3%. Median selling price went up 3%. But guys, when you have a small order, like 1,200 sales, and 100 of those are $1 million plus, and a $9.5 million Mamma Jamma house that's sold out there, it does skew that median sales price a little bit. And then as the percent of asking prices sold, and it's very high, 97, 98%. And that's because to even get a showing, you need to be priced with the market. Not above it, not 5%, 10% above it. You need to be priced kind of what you're worth, and then buyers have no problems looking at it then and making an offer pretty close to your asking price. But that's that. My advice for sellers is when I talked about fake COVID equity, every previous, I've always showed you, hey, this is what was selling before COVID, during COVID, and now, currently now, and I showed you 6 or 7 different communities that showed huge reductions in price. Do we think our prices are done going down for those kind of things? No, not with these stats that I'm looking at. So for you sellers out there that still want to, your house is worth more than it was in 2019, 2020, and if that is all fake COVID equity that's going away because it had no business going that high because of COVID, then you can still cash out of those things. I have my sellers do pre-inspections on their home because it is a buyer's market. Buyers are picky. Buyers will not go look at it. They will not make an offer if they think anything is wrong with it. And that's a very low cost for sellers to give peace of mind to buyers. And then this is just showing you the same thing I showed you last month. You know, how am I different than the other 20,000 agents that are out there, placing you in Zillow or the MLS and hoping for the best? Look at the views I had on this one home, which by the way, I sold. On day 15, I was getting 1,600 views. I know if you're watching this on a phone, you won't be able to read this, but total views, 18,000 on day 15 of this listing. So far, 15 days worth of that. My closest competitor gets 50 a day. My next closest competitor gets 17, and my third best competitor out there gets 1 view a day. The more eyeballs, the more views. How do I do that? It's my marketing plan. It's investing in making this sure that my houses are all exposed. And of course, I make my pictures look fantastic. And we did end up selling this home. If you price yourself accordingly and market your home differently than the competition, because 9,800 homes is a lot of competition, you will sell in this market. My advice for buyers is just be patient. I know I can keep saying times 3, times 4. When you have a market of falling daggers, you want to catch feathers. You don't want to reach. You don't want to jump ahead of it. You want to kind of make a price, stick to a budget, and say, can the house come to me? And so far for the last couple of years, yes, the houses are coming to you. So kind of be patient, sit back, and don't feel you have to be FOMO buying or that fear of missing out buying, that it's going to be gone. 9,000 plus homes is a huge pile of inventory. And so the more focused you are as a buyer, the more patient you are, it has been paying off. And let me show you my deal of the month. I didn't do one last month. People are like, oh, another new construction deal. You beat up these builders. Oh my God, that's so great, Ed. You showed us 6 times in a row. How about one that's a used house? A house that was priced on the market. We don't have a lot of homes under 200 grand in Cape Coral, especially ones that are on city water sewer that have 20, 30 grand worth of assessments but have been paid off. And here comes this house on a corner lot in the Southeast Cape that was priced at 175. What do you think happened with that house within the first week? Of course, we went to it, and the agent called me and said, I have multiple offers. Of course she does. The seller is giving everyone 7 days to go look at it and present an offer. What happens in this case scenario? Buyers think, oh my God, I need that home, and they feel that fear come in that they're going to miss out on it. But I don't let my buyers do that. We come up with a plan. First, obviously, I went to the house. I used 3 different ways to value that property, not just a CMA. I did 3 different valuations to say what it's worth. And I had prices ranging from $190 to all the way to $215, fixed up and brand new. So I put a $215 suggested price, but say the value is $210 all fixed up. We went to the house and I estimated the reno. I figured that reno was going to be around $15,000 to $17,000. I padded that thing to $25,000 to say, because as you start renovating a house, you might unearth some things that you cannot find just with your eyeballs. And then, of course, if we were to flip this house, we need to cover closing costs, commissions, and everything else. So you take that off that $210 price. And you take that number, we round it down, and our starting offer was a $150,000 starting bid. But our bidding strategy, before we ever had to negotiate and heard about highest and best, our cap was $171,350. I am exact to the math on that. The agent said she had 7 offers on the home, and she asked for highest and best. We stuck to this model, and our highest and best, the more I talked to my client, the more that she needed some more money to do some extra things she wanted to do with it, we offered $165,350. We filled out the entire contract with no blanks, complete, and what I call easy mode for the listing agent. I explained exactly what steps in my email. I called her. I had told her exactly when our inspection would be, which would be almost immediately, what trades were going to go at what time. The agent told me I was not the highest, but I was the best. And we got it under contract for $165,350. All the quotes this week so far have all come back, and I'm talking new plumbing, new floors, new kitchens, new bathrooms, paint, drywall, new electrical panel. The thing had a new roof. And the funniest thing is this lot would sell for $110,000 right now. City water sewer in and paid corner lot, oversized. If you just put a match to that house and burn it down, that thing's worth $110,000 just on the dirt alone. And it's got a new roof, and we're picking that up for $165,000. That's my latest deal going so far. You can see all the data that I acquire and all my sources. You can pause the screen here if you want to go on to any of these. And guys, I'm here to answer any of your questions. I want you to buy smart. I want you to do the numbers. I want you to let me do the math, make the right move. I'm available to you anytime. You can call me to discuss. If you're thinking of being a buyer, I want you to be qualified. I want you to be prepared so that we can jump if something were to come up. You can always go on to my teacherscomebuyhomes.com site. There's a survey there. And I do put out these videos once a month for my market update, but I do put out another video that's going on, what's going on at the time. And last month's video, which I'm going to flag up here in this video, was about, hey, what happens when my mortgage goes up? It's what's called the escrow domino effect. And I go over that as well. I hope to hear from you all. Thank you so much. Have a great one. Bye-bye.